Shall we start with the intro as people are kind of trickling in?
Yeah, let's do that.
Today we have a pretty interesting topic about stagflation. A little different from the inflation webinar we did a while ago because it has more broad economic consumer implications. And Ingo, our co-founder at Buynomics, is here to explain all of it. 1 second. And yeah, so basically, Ingo has over 12 years of experience in pricing, and he also developed the Buynomics method. And my name is Paul. I'm head of sales at Buynomics, and I'm here basically to give a quick intro, to moderate also the Q&A for you, and yeah, just guide us kind of through the topic today. And if you want to work with Buynomics, I'm also your first point of contact. If we go to the next slide here, then a quick introduction on Buynomics. Buynomics is a SaaS software empowering better pricing and revenue management decisions. We do this through a bespoke AI that Ingo himself developed. And this should lead to more holistic, accurate, fast, and profitable insights in pricing and revenue management. If we go to the next slide before I hand over to Ingo, we can quickly see some markets where we are established, so really around the globe, in a variety of industries, in, for instance, the consumer goods space, but also telecoms, software. So we cover quite a few different industries. And yeah, we'll also discuss kind of how different industries and different categories are impacted by stagflation today. And I already saw in the Q&A someone asking, maybe we can start by giving a definition of stagflation. So I'll hand over to you, Ingo, because I think we have a slide on this.
Yeah, thanks, Paul. Before we do, I think you were late to our last webinar and you missed the joke in the beginning. So I'll repeat it and I'll put one on top, and then I go into the details. So last time when Paul was late, we had a joke on that it's a good indication we're in trouble, that there's an inflation of inflation jokes. On LinkedIn, everywhere you see them popping up all the time. And actually, so there was an inflation joke on inflation, and now we're using it in an inflationary manner. So we're putting one on top. So we go from a squared joke to a cubic joke. I thought that Paul hoped that was a good addition. So, all right, so much for that. Yeah, and okay, so I think it's a good manner that we start by already answering the first question in Q&A. So what is stagflation? I think it makes sense to be clear about the term. So the way we understand it, it's a combination of stagnation and inflation. So it's two things. You have an increase in commodity prices, or triggered by an increase in commodity prices that then goes through all kinds of categories in the economy, in combination with a stagnation, which is expressed in reduction in GDP across many categories or many countries, an increase in unemployment, and a decrease as a result in overall demand. And typically, so the term was originally coined in the 1970s in the energy crisis with the increasing oil prices or a reduction in the availability of oil. And typically, this is triggered by a supply side shock, and that I think makes it particularly relevant at the time where we have things going on as the pandemic that we've had for the past about 2 years. Now with the war in Ukraine and other effects, we are in a situation where we're seeing that a supply side shock is beginning here in Germany. I think we're very close to it with a large dependency on gas. that these things can become real. And I think for us here, it's not necessarily in this webinar the role to go deeper into what causes stagflation. I think for us it's important is we just take it as a given. We definitely have inflation, and I think there is a growing threat of stagnation. And the question for us is what does it mean for commercial functions? So that means what does it mean for pricing? For products, so everything on the market side. This is what we want to discuss here, and put our view on it and shed some light on the topic in terms of what's relevant, I hope, for you as an audience. If you have any further questions, please just put them in the chat. We're happy to discuss these at the end of this webinar. All right, already said that we are seeing inflation. I think there's very little doubt about that. And we see inflation across a number of categories. Here are the numbers from the US, where I think 1 or 2 days ago, the new July numbers were announced at an overall inflation rate of 9.1%. But of course, this is just an aggregate number. In reality, we have very, very different inflation rates across different sectors, and we'll dig a bit deeper into that in a minute. So because we're interested in the effects on pricing, I think that the two main ways to look at that from a pricing perspective, the term stagflation is to look at it both as a combination of a cost increase and a decrease in demand. Whatever's going on, these are the two key effects that affect us. And to get started, I think it makes sense to simplify this question as much as possible. Look at, as it's usual in economics, look at the one product case and just get an understanding of what that means for the dynamics, what that means for how to react to a cost increase, to a price increase, and then we'll take it from there and look at that, what that looks like or what that means in the full realistic market complexity that we're all faced with. All right, so what does it mean? So here, very simplified, on the left side, we have the status quo, all good. We have a demand function, we have costs, and the red square here down here is the profit that we're making. Then if we go from left to right, two things happen. One is we have a reduction in demand. So at every price, people buy less, and we have an increase in cost going from C1 to C2 here. And that essentially means that we go from that large square of profit to the much smaller here. And essentially the question we have, for example, as a revenue manager or pricing manager is, what do we do with our pricing? And in this case, essentially, what we do is we increase the price a bit, with that lose a bit of volume. And that means we lose that square up here, but we gain this one here, which is a bit larger. So in this case, a price increase would make sense as costs go up and demand goes down. But typically, if demand goes down, we'll have a closer look at that. That means that if demand goes down, typically that means that elasticities go up, prices should go down. Whereas when costs go up, that typically means that prices need to go up. So these two things, the stagnation part and the inflation part, have an opposite indication on what that means for pricing. And it's very important to understand how to deal with these two forces in combination. All right, so I think this is something we've shown many times before. The question is always, particularly now with high inflation, getting close to 2-digit numbers, how do you pass on a cost increase? And that question, I think it's very straightforward, but it's often much more difficult to answer than is often suggested. And because it doesn't only depend on the price elasticity, but it also depends on what type of demand function we have. So if we have, for example, the simplest case, everyone knows this, linear demand. So this is here's volume, price, this here is the demand function. And in that case, you pass on half of the absolute cost increase. So for example, you have a product that produces costs of $100 and the costs go from 100 to 110. And if your current price elasticity is -2 in this point here, then your profit optimal price is 200. That is because in the optimum, margin times elasticity needs to be -1. So if your price elasticity is -2, then your margin should be 50%, and at a cost of 100, your price should be 200. So if your costs go to 110, you pass on half of that absolute price increase. So you pass on half of 10 euros, 5 euros. So the new optimal price is 205 euros. In the other case, you have, for example, an exponential demand so that your price elasticity is the same in every place. Then what you should do is you maintain your margin. So that means you stay at a 50% margin. And that means if as costs go from 100 to 110, your profit optimal price goes from 200 to 220. So quite a difference. Cost increase 10. And under linear demand, you should go to 105, 200, you increase by 5, and under exponential demand, you increase by 20. So there's already a lot of variation, and to properly react to a cost increase, you already need to know a lot. You not only need to know the price elasticity, but you also need to know what your demand function looks like. And that's of course something that can be seen or observed by looking at data in the proper way. We'll have a look at that later. So this is one side of the equation. And the other one, if we have a decrease in demand, so if you look at the graph here on the left side, we go from the original, here in this case, linear demand, to the lower line here. And that means we have about a 10% reduction in demand. So at every price, people buy about 10% less. What then happens under this condition is, let's say we're in the same spot we were before, price elasticity is -2, and the demand function goes down by 10%. Then at the same price, what happens is the elasticity now is -2.9. And that obviously has significant effects, has a significant effect on the profit optimal price. As before, we had a price elasticity of -2, cost 100, optimal price was 200. If we go to a price elasticity of -2.9, which happens because the demand goes down, we have the effect because margin times elasticity should be -1. The profit optimal margin is 43%. That means that the profit optimal price now goes down from 200 to 153. So these are opposing effects. In the previous example with cost increase, you should increase your price. With demand decline, which is of course very difficult if that happens, the profit optimal reaction is a price decrease. So, and this is what we just did. Was in the simplest example. So we had a one product case, there's no competition, no portfolio, no nothing. And these are the optimal reactions. And you can actually then, we won't do it here, but you can combine these two effects and look at them together. And then let's say if demand goes down 10%, price go up 10%, you can compute what that means for the new optimal price. Now, in reality, these things are, of course, much more difficult, but I think it's helpful to, when we get started to think about this, to start with a very simplified case. In reality, what happens is what we're seeing is that these things happen at different speeds. So if commodity prices increase, and with that, manufacturers are in a way forced to also increase their product prices, we immediately see that prices go up, typically of all products in a market. And with that, we have an immediate demand, an immediate reaction in the number of units sold. So as in this case, so we have a demand function, we increase the price and we lose certain sales, but the the demand function typically stays the same for a while. The demand function only changes after a while. So this is more of a midterm effect that happens after a while when consumers start to react to a changed situation. So when they see, for example, that they have less budget available because they are spending more on energy or other things, then they make changes to the demand function. So that means that this thing here, that demand goes down, which, as you can already see here, and in relation to the cost increase, the effects of a change in demand can be much more significant. This effect is something that happens at a later stage, and it can have a number of different causes. Customers react or make switches between different spendings, between different sectors, or at some point later on, what also happens if the whole economy adjusts to an inflationary scenario, inflation becomes endemic, and you have more frequent wage increases, so people have nominally more money. That, of course, also has an effect on the demand function. But it's important that this first effect, costs increase, then prices increase, that's typically very fast, and we're already seeing that take place. That's what produced the 9.1% inflation in the US. And these other effects, changes in demand, happen at a later stage. But this increases, of course, the complexity we're living in. And what also increases, of course, the complexity we're living in is that in reality, we're not just looking at a single product or the price of a single product, but we're looking at prices across a portfolio of our own products, the products of our competitors. We look at typically different portfolio products, in this case here, different sizes of chocolate bars, but almost everyone has some sort of a good, better, best offer. And if you change one price in a good, better, best offer, that affects, of course, the sales of all the other products in your portfolio, but also the sales of your competitors. You have interactions with your retailers, for example, if you're selling through retailers. And a change in prices might affect the balance structure between you and your retailer. It might have effect on the way promotions are run. If costs increase, promotions, of course, become much less attractive. And this we're already seeing has an effect on the frequency, for example, at which promotions are run. So there's in reality, I think the initial example was instructive, but in reality, we're looking at a much more complex world with much more different effects taking place. And also for that, the need for commercial functions to properly play all of these different levers. Maybe just before we go into the detail, just one interesting thing. I think the graph looks scary, but I think that's something relevant that's happening in the industry. And here again, very simplified, the idea of the given goods. So there are some goods or categories that increase in demand when their prices go up. And the typical simplified example is that of an economy that just consists of potatoes and meat. Meat is typically more expensive than potatoes. And at the status quo, people can buy 100 potatoes or 50 units of meat. And now the price of potatoes goes up. I think it doubles. So you can only buy up to 50 units of potatoes, 50 units of meat. So your demand function goes from this one here to this one. And with this budget constraint and your utility function, this would be the combination of the two products people buy. So they buy a lot of meat, few potatoes. And now as potatoes go up, they go from this point to this. So the new optimal point is at that combination here. So also potatoes got more expensive. People buy more potatoes than they did in the status quo. And of course, as a consequence, they buy much less meat here in this example. And this is just to highlight the effect that if there is inflation and inflation affects different products, different categories differently, the consumer response can be such that it also affects these different categories very differently. And even categories that don't have an initial inflation might be strongly affected by by these effects or by inflation in other categories. So here also for meat, everything stayed the same initially. It was affected by the increase in price of potatoes because it affected customers' budget constraints, and with that, what combination of potatoes and meat was optimal. So this is, I think this is always a very initially counterintuitive example, but important to understand the dynamics of what's going on. It's typically goes by the name of the given good. And we see this here. Initially, we had looked at the inflation rate, the overall inflation rate, I think in the US of 9.1. And if you break that down, you see that, of course, with fuel and gasoline, we have transportation, we have very high inflation rates, but also in products, computers and communication, telecommunication, for example, that aren't initially affected by inflation, that we see here, we actually see a decline in prices. That means the market is already reacting to the fact that people have to spend more in other categories, as we saw in the potato and meat example previously, that people are reacting, and that leads to a decline in prices in categories that are not initially affected by the inflation or the stagflation. All right, so we looked at initially in the graph, let me just switch my screen here for a second. We looked at a very simple example that I showed to highlight these effects. And what we weren't able to show in this example was the dynamics of how these things work together. Paul, can you see my browser now?
Yeah, I can see the epilogue players.
Perfect. So we're looking at a very simple example, and this is the solution that we offer, our tool that Paul mentioned in the beginning. So you can essentially use it to simulate these market dynamics, how to react to a cost increase, how to react to a change in demand, all of these things. And what this allows you is, just very briefly, the technology they developed is what we call a virtual shopper or virtual customer. And underneath, you can design your offer. So here, very simple in this example, apples and pears. They have costs, they have number of prices, and so on. And we offer these to a large number of these virtual shoppers that behave like real people. And if you change price, they change what they would buy. And with that, we are able to simulate the proper market dynamics, not just in a very simple one product case, but in all types of complexity. And of course, also the complexities that are relevant in actual market situations. So here we have an example where we offer apples, and our competitor offers pears, both at the same price with very similar demand functions behind them. We offer them here at 130, and we have these units. Both of us sell about 220 units. And what we can do is that when we change a price, here we increase the price by 10 cents, we lose a number of units. Some of these lost sales go to our competitor, and some completely go out of the market, so they don't buy anything at all anymore. And we can, for example, use it to see what happens if we change our prices, if our competitors change their prices, and what that means for revenue, profit, margins, price elasticity, everything that's relevant. Can look at these demand functions here, and we see when we look at our market and the competitor market that, as is typical in these competitive situations, we're both a bit too expensive compared to our profit optimal price. But as we know from the Nash equilibrium, if let's say we go to the optimal, then that pushes our competitor out of his optimal price. If the competitor goes into the optimal price, then we're again off, and this goes on until we find an equilibrium, which would be somewhere here. So this is the status quo, and we can look at these dynamics. So at the current price of 130, and we have here a price list of minus 2.9. If we now go to the case where we have stagflation, which is expressed in two ways. The costs have increased from 50 to 60 cents, and the demand, as in the example we showed previously, has gone down by 10%. What we see is that we have a reduction in the number of units here of about these 10-15% that I mentioned. And the question now is, what happens if what's our best price? And because we have both an increase in cost and a decrease in demand, our previous profit was 178 and it has gone down to 130 here, so quite a significant drop. And the question is, what's our best reaction to that? And of course, we can look at different things. So if it would be good for us if our competitor increased the price here, let's say by these 10, or let's say by 10 cents, because there was the cost increase. So that would initially hurt the competitor, but it would benefit us. And what you can then do, and what's relevant for the dynamics in a market like this, is to look at what are my options. So if I'm interested in profit, would it make sense for me, or what would it mean for the both of us if I increased my price, let's say by 5 cents, by 10 cents, and if we both increase our price here by 10 cents, the overall loss wouldn't be so high. So we have the option to look at these cases in this very simplified world with already the full dynamics and understand what it means if we have stagflation. So we have a decrease in demand and we have an increase in cost, what that means for our units, revenue, profit. And we can, for example, have a very detailed look at that. And we can also, of course, do that in a more realistic case. So here also more realistic. So we have 4 own brands, 3 competitor brands in a full market, and we can here look at these dynamics as they play out in a more realistic market. And we see that if we here increase the price where these units go, so we lose about 15% units. Many of these go to our own products, but also some go to our competition. And with something like that, we can look at the complexity of such a market and see, okay, if compared to the status quo, my costs go up, what does that mean for my profitability? And what are the best options for me to take? Maybe I also increase my price. Maybe I change my portfolio. What happens if competitors react or not react? And this, I think, something like this gives you the transparency to understand how inflation together with a decline in demand, so the stagflation scenario, how that would affect your overall portfolio, and what's the best way to react to it, not only looking at price and product, but also, if you want, by looking at changes, for example, here in the retailer discount, bonus schemes, or the way you run your promotions. So that was just a quick show of, I think, how we can look at these dynamics. Let's go back to the presentation. And I think we are close to the end. Yeah, so I think to close this webinar, I think what we put together, Paul and I, a number of hypotheses on what we think stagflation means in the market, and we're happy, of course, to discuss these. I think there are 2 effects on the market side. One is that we expect it, and we're already seeing that in categories, a move towards the lower priced end. So within categories where people need to spend because they're non-discretionary, then the products people might tend, or some people tend to go to the lower priced products. We see that for discretionary categories, vacation, other things, that these will come under pressure overall, as we showed in the potato meat example. And what we're seeing within categories is because we've had a more or less stable world for a number of years now that gave companies the opportunity to find I would say a fairly stable market equilibrium, and we're now seeing a disruption of that with high inflation, potentially increase and the potential demand decrease that differs across categories. So the market needs to find a new equilibrium. So we're expecting to see an increase in competition, and we're expecting to see an increase in the variation of what companies will offer to find out what works best, maybe a price increase, decrease, change in product, change in promotion strategy, and so on. We expect the best, that those companies with strong brands and those with agile processes, particularly taking the best use of technologies like the one we just highlighted, that allow companies to quickly assess what are the best moves in the market, that those will be the companies that win and will benefit from the increased variance that's coming into markets at the moment.
Can you show the slide for this as well? I think we have a slide just, but everyone attending will get it.
Yeah, I thought I had it.
We'll get it.
I knew that there was something wrong when I didn't see you. Now you see it?
Let me see. Yes.
Okay, here it is. Yeah, so there was a slide on it. So these are the 5 things we're expecting as a hypothesis. So just to summarize very quickly, within categories, a move towards the lower range, price range, and then a shift between categories, more spending on reduced spending on discretionary categories, and within categories and markets, an increase in the variation because companies will try out price increases, decreases, new offers, a change in promotions, and so on. And we expect those to do best in this environment with strong brands and agile processes, so they can properly manage the increased complexity in what's going on in their markets.
Perfect. Great. I think we also have an upcoming webinar that I quickly want to point out to our attendees here. Again, you can ask any questions in the Q&A. I already answered a few. And I hope that was helpful. The next webinar will be on deciding and measuring the right KPIs for pricing and revenue management decisions. So that's quite an important one, how to actually quantify your targets and measure them correctly. I think that's quite an interesting one. I have one last question for you, Ingo, just coming through in the Q&A. So they ask, how are the virtual shoppers maintained? So I'm assuming that this means how are they updated, or how do we make sure they are relevant?
Yeah, so they work with any type of data on pricing. So from sales data, transaction data, to surveys. So you can do any type of pricing survey up to a conjoint study and use the insights to update these virtual customers. And of course, sales data that companies typically have available. And also, I think, so what we're seeing is that, for example, in sales data, but also other sources, the effects of how demand changes. In the presentation, we had these slides on what to do with the decline in demand. So these things can be measured very quickly as the data come in. So particularly in fast-moving goods, you very quickly see if the market reacts and demand goes down, and then is used by the technology to update the virtual customers and gives you the option to very quickly see how that affects demand, and with that, what your best pricing reaction could be.
Sorry, I was on mute. Someone's also asking whether the webinars are available on our website or other social platforms. So yes, you can find them on our YouTube channel, where we upload them every 2 weeks. And you can also find them on our website under the Insights section. And if you've registered for this webinar on Zoom, you'll also receive it as a recording by email. So look out for your inbox. We'll usually send that on Monday next week. Yeah, great. So thanks a lot, Ingo. A super interesting topic. I think the economy is something that's top of mind for everyone, but especially for experts working in commercial functions around pricing, revenue management, marketing. So quite an interesting topic. And yeah, looking forward to seeing you all next time when we talk about measuring the right KPIs. Have a great weekend and see you soon.
Thanks.